BlackRock, the firm that controls $10 trillion, more money than the GDP of every country except the US and China, had just made a bet that could destroy traditional banking forever. In the last 180 days, they've accumulated $35 billion in Bitcoin. That's the fastest growing financial product in Wall Street history. And 3 major banks are already bleeding deposits at a rate that will make them insolvent by March if it continues. But here's what nobody is talking about. This exact pattern happened twice before in the last 50 years. In 1971, institutions that recognized it early made 2,200% returns. In 2008, one hedge fund made $15 billion in a single year. Both times, traditional banks that ignored the warning signs collapsed. I'm going to show you the pattern. I'm going to show you the data. And at minute 13, I'll reveal the exact timeline of what happens next, including the specific week I predict the first major bank announces bankruptcy. Stay with me, because if I'm right, the window to position yourself closes in less than 60 days. Before we dive in, let me be absolutely clear about what this video is and what it isn't. I am not a financial advisor. Nothing in this video is financial advice. I'm not telling you to buy or sell anything. What I'm doing is showing you publicly available data, historical patterns, and connecting dots that mainstream financial media is either missing or deliberately ignoring. Every claim I make will be backed by specific numbers, dates, and sources you can verify yourself. When I speculate, I'll tell you it's speculation. When I show you facts, you can check them. Let's begin. Let me give you 3 numbers that explain everything. Number 1, BlackRock's Bitcoin ETF launched January 11, 2024. In 281 days, it accumulated $35.6 billion in assets. To put that in perspective, it took gold ETFs 5 years to reach $10 billion. BlackRock did more than triple that in under a year. Number 2, in Q4 2024, U.S. commercial banks saw $472 billion in deposit withdrawals. That's the second largest quarterly outflow in American banking history. The only bigger outflow, Q1 2023, right before Silicon Valley Bank collapsed. Number 3, Bitcoin's market cap grew from $846 billion in January 2024 to $1.9 trillion in December 2024. That's over $1 trillion in new capital in just 11 months. Now here's the question nobody in mainstream finance wants to answer. Where did that $1 trillion come from? The answer, and this is what banks are terrified you'll figure out, is that it came directly out of the banking system. Here's the mathematical reality. Banks operate on fractional reserves. For every $100 you deposit, they keep about $10 in reserve and lend out $90. That's how they make money. But if depositors pull out more than 10% of deposits, banks can't cover withdrawals. They have to sell assets at a loss, which triggers panic, which causes more withdrawals. This is called a bank run. Right now, total U.S. bank deposits have fallen from $18.1 trillion in March 2022 to $17.2 trillion today. That's $900 billion gone. When deposits leave, banks don't just lose money sitting in accounts. They lose the ability to generate revenue through lending, and the data shows much of that money is flowing into Bitcoin. The correlation isn't coincidence, it's a pattern. And to understand where this goes next, we need to look at history, because this exact sequence has played out twice before, and both times the outcome was dramatic. Let me take you back to August 15, 1971. President Nixon appears on television and announces, the United States will no longer convert dollars to gold. This ends the Bretton Woods system that governed global finance since 1944. Most Americans had no idea this was coming. But here's what the history books do and emphasize, and this is the part that proves institutions always see it first. Between January and August 1971, foreign central banks converted $8 billion worth of dollars into physical gold from Fort Knox. That's $60 billion in today's money. They were withdrawing gold 6 to 8 months before Nixon's announcement. Germany withdrew $2 billion in gold. France had been converting since 1965. Why? They understood the math. The US had printed more dollars than it had gold to back them. The system was going to break. The only question was when. And here's the number that proves they were right. Gold was $35 per ounce in August 1971. By January 1980, it hit $850 per ounce. That's a 2,328% return in less than 9 years. Meanwhile, the dollar lost 52% of its purchasing power during the same period. Banks that held primarily dollar-denominated assets watched their real value get cut in half. Institutions that moved into hard assets before Nixon's announcement preserved and multiplied their wealth. Here's the critical insight. The institutions that positioned early didn't wait for Nixon's announcement. They didn't wait for consensus. They looked at the data dollars printed versus gold reserves and moved decisively. They were called unpatriotic, they were called alarmists, they were right. The bankers who trusted government assurances watched their competitive position erode for a decade. By the time everyone figured it out, the opportunity was gone. Pattern established. Institutions with superior analysis position ahead of consensus. They look at mathematical realities, not official narratives, and they move before everyone else catches on. Now watch how this same pattern repeated in 2008, but this time we have the smoking gun that proves it. Fast forward to 2007. Housing prices are at all-time highs. Banks are issuing mortgages to anyone with a pulse. The Federal Reserve Chairman says the subprime crisis is contained. Financial experts on television explain why housing prices can never fall significantly nationwide. But behind the scenes, a handful of hedge funds and investment banks are doing the math differently. They're analyzing subprime mortgage default rates. They're examining housing price-to-income ratios. They're looking at the structure of mortgage-backed securities. And they're realizing the entire system is built on one assumption: that housing prices will rise forever. Here's the evidence. In December 2006, Goldman Sachs' mortgage trading desk began taking short positions against the same securities their sales team was selling to clients. Internal emails show this clearly. They were literally betting against their own products. Why? Because their analysis told them the math didn't work. When the crisis hit in September 2008, Goldman Sachs reported $2.3 billion in profits for Q4, the same quarter that Lehman Brothers went bankrupt. Bear Stearns collapsed and sold for $10 per share, down from $170 just a year earlier. Washington Mutual failed in the largest bank collapse in U.S. history. Meanwhile, John Paulson's hedge fund made $15 billion in 2007 betting against subprime mortgages. Michael Burry's fund gained 489% that year. These weren't insider trades. They were pattern recognition based on publicly available data. The institutions that survived read the data, positioned early, and ignored the consensus. The institutions that trusted official statements got destroyed. Now what kept me up at night when I discovered it. This exact pattern is happening right now with Bitcoin and banks, but this time the timeline is compressed. Let's connect the dots with current data that anyone can verify. Data point 1. BlackRock's Bitcoin ETF has $35.6 billion after 281 days. Fidelity's has $14.8 billion. Grayscale has $19.4 billion. Total institutional Bitcoin ETF holdings, over $71 billion as of December 2024. Data point 2. Larry Fink, BlackRock's CEO, called Bitcoin an index of money laundering in 2017. In 2024, he calls it digital gold and predicts it will become a major portfolio allocation globally. What changed? He read the same patterns we're discussing now. Data point 3. Bank deposits peaked at $18.1 trillion in March 2022. Today, $17.2 trillion. That's $900 billion in outflows, and the rate is accelerating. Data point 4. Bitcoin's market cap grew from $360 billion to $1.9 trillion during the same period. The correlation is undeniable. Now let me explain why this matters structurally. Here's the critical insights banks are terrified you'll understand. Bitcoin represents disintermediation. Banks make money by sitting between you and every transaction. They custody your money, they process your payments, they verify your identity, they keep the ledger. For all of this, they extract fees. Bitcoin eliminates the intermediary completely. It's self-custodial, peer-to-peer, a distributed ledger that doesn't need banks. This isn't about competition. This is about banks potentially becoming obsolete. Think about what happened to travel agents when Expedia launched, or Blockbuster when Netflix arrived, or taxi medallions when Uber started. The incumbents didn't just lose market share, their entire business model became unnecessary. That's what Bitcoin represents to banking, and BlackRock knows it. So instead of fighting it, they're positioning ahead of it. Just like institutions positioned into gold before 1971, just like Goldman positioned against mortgages before 2008, the numbers don't lie. The pattern is clear. Banks are bleeding deposits. Bitcoin is absorbing capital. And if history is any guide, we can predict what happens next with reasonable accuracy. Let me be crystal clear. These are predictions based on historical pattern analysis, not certainties. But the confidence level is high because we've seen this movie twice before. Here's the exact timeline I expect. Phase 1. Next 30 to 60 days. January-February 2025. What I predict we LLC. At least 2 more major asset managers, likely Vanguard and State Street, announce Bitcoin ETF products. Institutional allocation recommendations increase from current 1 to 3% to 5 to 7% of portfolios. Bitcoin tests a $120,000 to $130,000 range as institutional buying accelerates. Most importantly, a regional bank with $50 to $100 billion in assets will announce extraordinary measures to retain deposits. This will be the first public signal that deposit flight is becoming a crisis. Phase 2. 60 to 120 days. March-April 2025. Financial media shifts from dismissing Bitcoin to crisis coverage about banking disruption. The Federal Reserve faces an impossible choice: raise interest rates to make bank deposits more attractive, which crashes the economy, or keep rates low and watch deposits continue fleeing to Bitcoin. Bitcoin likely reaches $180,000 to $220,000 range. But understand, this isn't Bitcoin becoming more valuable. It's the dollar requiring more units to buy the same asset. Here's my specific prediction, and this is what most people will miss even when it happens. During the week of March 17th to 24th, 2025, I predict a regional bank will announce bankruptcy or emergency merger. Not because of fraud or mismanagement, but because deposit flight has made them mathematically insolvent. When that happens, it triggers Phase 3. Phase 3, 120 to 180 days, July 2025. Foreign central banks accelerate U.S. Treasury selling. China and Japan combined hold $2 trillion in treasuries. If they sell even 10 to 20%, the U.S. government struggles to finance its deficit. The Federal Reserve becomes the buyer of last resort, creating money to buy government bonds. This is the classic currency debasement spiral. Major banks announce their response. Some will launch Bitcoin custody services and survive through adaptation. Others will lobby for regulation and fail because Bitcoin is global and decentralized. Most likely we see a combination, a messy transition where some banks adapt, many fail, and the system fundamentally transforms. The timeline compresses because information moves faster now. What took a decade in 1971 and 2 years in 2008 happens in months this time. Let me address the strongest arguments against this thesis, because intellectual honesty requires it. Argument 1. Bitcoin has crashed 70 to 80% multiple times. Why is this time different? My response. Previous crashes happened when Bitcoin was purely speculative retail investment. Now we have over $71 billion in institutional ETF holdings. BlackRock doesn't buy assets to go to zero. The market structure has fundamentally changed. Could it still crash? Yes, but institutional backing creates a floor that didn't exist before. Argument 2. Governments will ban Bitcoin before letting banks fail. My response. China tried this. Bitcoin survived and thrived. You cannot ban a decentralized global network. You can only push it underground, which makes the crisis worse. The US government learned from China's mistake. They're not going to repeat it. Argument 3. Banks have survived for centuries. They'll adapt. My response. Yes, some will. That's exactly my prediction. But some adapting means many failing. Travel agents adapted to 10% survived. The other 90% vanished. Banks will adapt or die, but most will struggle. Argument 4. This is just another bubble. My response. Maybe. But previous bubbles were about price speculation. This is about institutional positioning for currency debasement. Even if Bitcoin's price crashes 50% tomorrow, the underlying pattern continues because the problem on sustainable government debt and money printing doesn't go away. These are legitimate concerns. I'm not dismissing them. I'm showing you both sides so you can make informed decisions. Let me bring this home. In 1971, institutions that recognized the pattern made 2,328% returns while others lost half their purchasing power. In 2008, institutions that positioned early made billions while banks that trusted conventional wisdom collapsed. Today, BlackRock has positioned $35.6 billion into Bitcoin in less than a year. This isn't speculation. This is the world's largest asset manager reading the same patterns we've here discussed and acting on them. The implications for you are profound. The financial system we've known our entire lives is transforming. The institutions we trusted are facing an existential threat. The currency we use is losing purchasing power faster than official statistics admit. I'm not telling you what to do. I'm showing you the pattern, the data, and the historical precedent. What you do next is entirely your choice and your responsibility. But understand this, by March 2025, when my prediction about bank failures either proves correct or proves wrong, the early positioning window will have closed either way. The masses will react to headlines. By then, institutions will have already positioned. History rewards pattern recognition. History punishes consensus thinking. The question is simple. Do you move based on data and patterns, or do you wait for confirmation from authorities who have every incentive to maintain the status quo? Banks have two choices: adapt or die. For individuals, the choice is whether to position before the pattern becomes obvious to everyone, or wait until it's too late. BlackRock has made their move. The pattern is clear. Now you know why. I am not a financial advisor, and this is not financial advice. This video is for educational purposes only. All investments carry risk. Past performance does not guarantee future results. The predictions made in this video are speculative analysis based on historical patterns and could be completely wrong. Always consult qualified professionals before making any financial decisions. I may hold positions in assets discussed in this video. If this analysis helped you understand what's happening, subscribe. Tomorrow I am breaking down why China just reduced Treasury holdings by $147 billion and what it signals for the dollar's future. The pattern continues. Remember, institutions always move first. The question is whether you'll recognize the pattern early or late. Make your choice wisely.